At this very second, Open Door Technologies Inc., trading under the ticker OPEN on the Nasdaq, is exchanging hands at $7.37. The market has been open for a few hours, and we are seeing a tense, choppy intraday session where the stock is currently up roughly 0.95%, oscillating between a low of $7.02 and a high of $7.75. The volume is already heavy, clocking in at over 48 million shares traded, which signals a fierce battleground between the bulls trying to defend the $7 line and the bears pushing for a breakdown. This price action tells a story that is far more complex than a simple green day on the charts. The expectation leading into this session was that the dust had finally settled from the explosive Q3 earnings miss earlier this month. Most retail traders expected the stock to languish or drift lower as tax loss harvesting season approaches. But the reality we are witnessing right now is a stubborn refusal to break support. The stock is showing a hidden divergence. While the headline numbers from the recent quarter were objectively poor, the buying pressure at these levels suggests that institutional accumulators are stepping in, betting on something the average headline reader is missing. This creates a massive curiosity loop. Why is big money absorbing shares of a company that just guided for a 35% revenue drop next quarter? To understand this, you have to look beyond the simple price tag and look at the structure of the movement we have seen over the last 10 trading days. Since the drop from the $10 highs seen earlier in the summer of 2025, Opendoor has been carving out what technical analysts might call a consolidation base, but which looks more like a coiled spring to those watching the order flow. Today's candle on the chart is particularly telling. We saw a sharp dip at the open, driving the price down to $7.02, almost piercing the psychological $7 floor. In a weak stock, that level would have shattered, triggering a cascade of stop-loss orders. Instead, buyers stepped in aggressively at $7.05, leaving a long lower wick on the daily chart. That wick is evidence of demand. It tells us that despite the fear-mongering in the forums and the bearish analyst notes, there is a sophisticated class of investor willing to bid this up the moment it sniffs oversold territory. The broader context here is the clash between the old Opendoor narrative and the new reality under CEO Kaz Nagyodian. The expectation for years has been that Opendoor is simply a house-flipping algorithm, a capital-intensive, low-margin business that lives and dies by the spread on home prices. If housing prices drop, Opendoor loses. That is the simplified consensus view that keeps the stock suppressed. However, the reality emerging in late 2025 is that Opendoor is aggressively shedding its identity as a prop-tech flipper and reskinning itself as a software and AI-first logistics platform for real estate. This is not just a branding exercise, it is a fundamental shift in how they utilize capital. The market is struggling to price this transition. Is it a desperate pivot to save a dying model? Or is it the maturation of a platform that will dominate residential transactions regardless of asset prices? The tension between these two beliefs is what causes the volatility we are seeing on the screen right now. We need to talk about the earnings fallout because it is still the primary weight on the stock. The Q3 2025 report released earlier this month was a cold splash of water for the bulls. Revenue came in at $915 million, missing expectations, and the company posted a loss of 12 cents per share. But the real pain point was the guidance. Management projected a 35% sequential decline in revenue for the fourth quarter. On the surface, this looks disastrous. It looks like a company shrinking. However, a deeper analysis of the exclusives marketplace and their new direct-to-consumer channels suggests that this shrinkage is intentional. They are deliberately throttling back on buying high-risk homes to focus on inventory that turns over quickly. The expectation was growth. The reality was a strategic contraction to preserve cash. This disconnect is where the opportunity and the danger lie. Let's shift gears to the macroeconomic backdrop, which is acting like a headwind and a tailwind simultaneously. The 10-year Treasury yield has been volatile, and mortgage rates have refused to come down as quickly as the Federal Reserve's dot plot suggested they might. For Opendoor, high rates are a double-edged sword. On one side, they crush demand. People simply cannot afford to move, which reduces the total address market of sellers for Opendoor to court. On the other side, high rates and a frozen market make Opendoor's value proposition, certainty and speed, more attractive to the few people who must sell. If you're moving for a job or a divorce in a market where homes sit for 120 days, Opendoor's cash offer becomes a lifeline, allowing them to negotiate wider spreads. The market pricing today reflects a bet that the lifeline aspect is starting to outweigh the crush demand aspect. Now, I want to address a specific elephant in the room regarding leadership. The rhetoric coming out of the C-suite has changed drastically. There is a new level of aggression in how they talk about costs. CEO Kaz Nagiodian has been quoted recently making incredibly blunt statements about cutting bloated workforce segments, questioning what large percentages of the staff actually do. This is not the soft, polished language of the previous regime. This is wartime CEO behavior. Investors are divided on this. Some see it as a sign of a toxic culture imploding. Others see it as the necessary discipline required to turn a cash-burning machine into a profitable software giant. This polarizing leadership style is fueling the volatility. When a CEO signals they are willing to break things to fix the bottom line, it shakes out the weak hands, which is exactly what we saw in the sell-off last week. Comment below. Do you think Nagiodian's aggressive cost-cutting is exactly what Opendoor needs, or is he cutting too deep and hurting the business? I want to hear your take on this leadership style. This brings us to the critical section on short selling, which is absolutely vital for anyone holding or watching Open right now. You cannot trade this stock without understanding the short interest dynamics. As of the most recent reporting period ending October 31, 2025, the short interest in Opendoor stands at a staggering 163 million shares. To put that in perspective, that is a massive chunk of the float. The days-to-cover ratio is currently hovering around 1.6. Now, you might hear 1.6 and think it sounds low, but you have to interpret that in the context of the massive daily volume. The volume is so high, often over 100 million shares a day, that the ratio looks small, but the absolute number of shares short is enormous. What does this mean for you? It means there is a massive reservoir of latent buying power trapped in those short positions. If Opendoor releases a piece of unexpected good news, say a partnership with a major mortgage lender or a sudden drop in interest rates, those 163 million shares have to be bought back. This creates a distinct powder keg setup. We are also seeing interesting data regarding failed-to-deliver cycles. When short sellers attack a stock aggressively, they sometimes fail to locate the shares to borrow, leading to FTDs. We have seen spikes in FTDs for Open throughout late 2025, suggesting that the selling pressure is artificial and strained. Actionable insight here. Watch the borrow fee rates. If you see the cost to borrow Open shares spike on your brokerage platform, it means the pool of available shares is drying up. That is often a precursor to a squeeze. Also, keep an eye on the $8 strike price in the options market. There is significant open interest at that level. If the stock pushes through $7.80 and challenges $8, market makers who sold those calls will be forced to hedge by buying stock, which could trigger a gamma squeeze on top of a short squeeze. This is not a guarantee, but it is a structural vulnerability in the bear case that you should be monitoring. You must also be aware of the retail sentiment landscape, particularly on platforms like Reddit and X, formerly Twitter. The chatter around Opendoor has shifted from diamond hands optimism to a more cynical, show-me-the-money attitude. However, there is a growing subset of traders analyzing the Nagiodian put, the idea that the new CEO is so determined to hit the 2026 profitability targets that he will engineer financial maneuvers like the recent warrant dividends or aggressive buybacks to defend the stock price. When you see coordinated discussions about locking the float or complaints about market manipulation regarding the short interest, understand that this reflects a highly emotional investor base. Emotional bases panic sell at the bottom and FOMO buy at the top. Your job is to remain cold and analytical. Let's zoom out for a moment and revisit what Opendoor actually does for those who might be new to the story or confused by the recent pivots. At its core, Opendoor invented the iBuying category. They use algorithms to value homes, make cash offers to sellers, perform light repairs, and resell them on the open market. The traditional model was heavy on capital. They owned the homes on their balance sheet, meaning they carried all the risk. If the market tanked 10% while they held 5,000 homes, they took a massive hit, which is why the stock crashed in 2022 and 2023. The new Opendoor, the one you're investing in today, is trying to move toward a marketplace model. They want to connect sellers with buyers directly, taking a fee for facilitating the transaction, financing, and title work without necessarily taking the home onto their own books. This is the exclusives marketplace and the Opendoor for Agents initiative. If they